have questions, we have answers. This is Jane Miller.
And this is Ken Miller. Welcome to our show, all about real estate with Ken and Jane. Well, Jane, Wednesday, the Fed raised the rate again, as expected. It marks the 10th consecutive rate hike by the Fed. And so that could affect the lending rates. And we have as our special guest today to discuss the real estate market and the lending, Michael Vrlaku, who is a senior VP with Guaranteed Rate Affinity. Michael, welcome to our show.
Hi, good morning. Thank you, Jane.
Great.
Thank you, Ken.
Thanks so much for joining us today.
Oh, my pleasure. Happy to be here.
Great.
This has been a long time we know Michael, right?
Yes, we go back many years.
Over 10 years, over a decade. I really always appreciate your professionalism, your advice, and your experience, and the most importantly, you care about your client and you care about staff work for you. And it's a great asset for whoever your clients. Yeah.
Appreciate it. Thanks, Jane. The interesting part about 10 years in today's market, we've been through a number of markets kind of together, right?
Yeah.
Buyers markets, sellers markets, yes. Somewhere in between. So it's kind of interesting as we kind of cover these topics today.
Right,
Absolutely.
right. So to start, just give us a briefly what your company's about and what you do there.
Sure, thanks. So I recently moved to Guaranteed Rate, which is the third largest mortgage company in the country. And I had most of my career at big banks, and big banks have, their buy box, what they really do. And a lot of times that's what they really do well. And so, there's been a lot of trouble at big banks. And
I know.
Now I'm approaching my 20th year in the business. And I thought it was a good time to kind of shift away from the big banks, and I've gone to Guaranteed Rate because there's just so many programs. So with the challenges in the market, having more programs, having more options for my customers really was the move that I thought made the most sense. Some flexibility with the guidelines, the flexibility with credit scores, down payments, things of that nature, and then the speed. Right, so this is a seller's market, as we know, especially in this area. And so big banks are a little bit slower. So Guaranteed Rate, we have
Mike, you're being very kind. I don't want to say any banks, but big banks are a little bit slower or a lot slower.
I
don't want to. We can tell you stories, and
Ken, you don't have to tell stories.
With getting pre-approvals from big banks, it became an issue. It became such a hot topic that we would almost that sometimes some agents shy away from even dealing with them because of the experiences, the prior headaches and horrendous experiences they've had dealing with them in the processing. And I had one particular with a bank. I won't say the name, but it was like you dealt with the loan officer, then they sent it to Pennsylvania for another processor, and even with a short sale, it took a year and then by the time the file became ripe, the appraisal expired, so I had to pay for another appraisal because it took them 4 to 6 months to just get to process it. And that's the kind
Ken, you don't have to remind Michael. When he was, once again, we can't say the name of the bank. He was a regional manager. Right. How many times poor Michael had to listen to me, call him complaining. I can't believe it. Your back office, I mean, you call the processor, you call the regional, you call everybody, just like go nowhere. It's fun. Sometimes for me, the frustration is when the bank is become very big. Now we have a problem with a lot of small banks, regional bank in financial difficulty because the policy, so on and so forth. But the big bank is too big. Left hand doesn't know what right hand does. So that time, I mean, I'm glad finally, after all these years I know you come to the bank, which can get around it very quickly.
Thank you, Jen. I think a lot of people said the same thing, is that there have been, over the years, they say, oh, leave this bank or that bank, and, then we could do more business. And so a lot of people are excited that I've made this transition. And, Ken, I mean, I've been doing this, and I think I'm pretty good at it, right? I take it very seriously. So when there's a certain level that's within my control, and as long as I set the proper expectations and I deliver on those, and I have, even at the more challenging banks that I worked at. But now the expectation on the seller side, when you're getting so many offers, or you really want to move fast and you want to close quickly, and with the bank struggles, it's just that combination. All of a sudden, it's like, well, what's best for my clients, what's best for my partners, and that's really more of a mortgage company that has the flexibility and has the programs to get a single day, 24-hour approval.
Yes.
Right. And you have more control over the process. Nothing against big banks, but in the big bank, your role is limited because you rely more on other people's, in this particular role, you have the more control and oversight over the whole process, so you can ensure that it gets done in a timely manner. I would think that's a
bonus. I mean, in a big bank, too many desks, like a clearing department, and it's just like you have to go through so much process, and sometimes the file could be end up with someone's desk for 4 hours. The person not there, have a meeting, whatever. Each step take long time, So at the end of the day, it's very frustrating for the seller and the buyer because we have to not only the pre-approval and loan clear to close, right, and then all these issues, right, follow up. Sometimes, they have to schedule the mover. If we can't close that day, they have to make another arrangement. They have the seller where they go, buyer they have to handle with their current situation, the residency. There's a lot together. It's a lot on their mind. So if you
definitely more layers.
Yeah. If the lender like now, right, if the bank can pretty much give a accurate date. That's, at the end of the day, a lot of time, Michael, it's not like you have to be on time per se because all New Jersey contracts are approximately, right? But at least you let us know. And with a big bank, sometimes we just don't know. You call, there was a voicemail.
No, or you can't get the processor. So you call the 1-800 number, and then the person you speak to, you've got to explain the whole file. He or she has to look it up, and they're just looking at the notes and say, well, let me send the notes. I'll send another note by email now to the processor.
It takes a half an hour to get through in the first place.
That's why you lose that person-to-person connection with the loan officer or the processor.
Sure. I mean, on a grand scheme, that's the experience, right? That everyone has with big banks. Of course, from working with me over the years.
You'll always help. I have to say, right?
I'm there to do it, but still, my response might be, I'll get it fixed or figured out by the end of the week. Whereas now, what's within my control is more in an hourly basis.
And more now. And this is a now society, right? Everyone, with email and text, everyone is on the clock.
I have to say, even in that the difficult time when you were in a big bank manager, regional manager position, you're always helpful. You're always, very patient, very helpful, sometimes out of your way even to make sure, give me something so I can let my party know I tried, right? So
that's what we do, right?
You always go above and beyond for the client. And for the agent, too. So for that, I was grateful.
Thanks, Jane.
Why don't you give your contact information before we go further? Yeah.
Sure. So best way to reach me is really my direct line. And this is kind of like part of my sales pitch, right? It's like, hey, I've been doing this 20 years. As Jane said, she's known me for so long, and I'm here. Obviously, she respects that, I do good business, and I do right by everybody. And I say to everyone, part of my sales pitch is, hey, this is the number my wife and kids call me on, so feel free to reach out to me anytime. I work all the time, and my number is 732-977-9970. Feel free to give me a call or text, and I'm happy to help. So
fantastic.
Well, thank you for sharing your cell phone with our listeners. That's much appreciated, right? All right, so let's move to the Fed. This past Wednesday, they raised the rate again, which wasn't surprising for the 10th consecutive time. So the rate now, their policy rate is set somewhere between 5 and 5.25%, its highest level since September 2007. Powell seemed to indicate he didn't use the word ongoing increases. So there's some hope that the Fed, this might be it for the foreseeable future. So I want to get your take from the borrower's standpoint. If the most recent Fed hike is going to have a future impact on the rates, or did the banking industry already adjust for this rate hike?
Sure. I mean, I think you segued this perfectly in the sense that this wasn't a surprise. And so there's no direct correlation to a Fed increase to a mortgage rate increase. So there is to credit cards and home equities and student loans, things like that, but no direct for a mortgage. And so if there's no surprise, then it's already baked in essentially, right? So, as rates rise, everything will kind of rise with them a little bit to some extent, but it's still supply and demand. Who wants to buy mortgage bonds? Who wants to buy treasuries? that's what's bringing and keeping rates somewhat low in this inflated, interest rate environment. So will it impact future? I mean, I think the Fed really doesn't know. They haven't known. They got it wrong for so long, and they continue to really be unsure about what the future holds. And some of the comments is just like, we'll see what the reports say, and then we'll make another decision. And that so they're not predicting very well.
And that seems to be the theme all throughout every speech. Because in no disrespect to him, but Chairman Powell, I don't think they really don't know. They just get the data. They have to say, well, let's wait and see. Just like the doctor says, well, let's see if this treatment's going to work. Let's wait and see till we get the blood work again. Let's see if how it responds. So a lot of it is just a wait and see, right? Wait till the CPI data comes or the PCE data and see what the numbers show.
Which I think is a good stance at this point. I mean, because stop projecting if you're going to be wrong all the time, right? Might as well just say let's
we don't know.
Let's wait, right? Let's not try to upset the markets. I think that's probably their priority at this point. Mm-hmm. Let's be as transparent as possible as, hey, we don't know, and depending on what the report is, then we'll make a decision then, and that's really what's going to impact the buyers, right? So if we heard that the Fed raised the rates, that's no direct impact. Your mortgage rate didn't go up. If you had a pre-approval last week, it didn't adjust this week. In fact, the rates kind of came down a little bit, and that kind of typically happens a lot of times because they're baking in a potential downside to mostly commentary, not necessarily what the interest rate change would be.
Yeah.
Right.
I mean, I think not look at it back, right? Last year, in my opinion, they raised the rate too frequently. So sometimes, just like Ken gave example, right? If someone gets sick, you give them a dose, you give them second dose, third dose. Don't you think you should slow down to see what the dose working? That was, in my opinion, once again, I'm only a little realtor here. I don't know the economy and things like that, right? There must be a reason for them to do so. But by doing so fast, I feel when you add up the little dose together in such short period, right, may create a more mass than like we see today, right? If you have a ring, if you do a little bit to 2 days, 3 days period, rather than just rain in 2 hours, 3 hours, you had a flood happening. So I think maybe this time the signal could be stop a little bit. Maybe it's a good for the market. Everybody have a break and reevaluate.
Well, the other reason to kind of stop is like, well, what effect are you even having?
Yes.
Right. So to your point a little bit as to let's wait and see what effect it has happened and then we'll make some decisions. So I do think that they're slowing down, but there's a lot of things that I personally consider there are major world powers who are manipulating so many different things. So it's hard to predict right now. But with that being said.
Right. So let's turn it to the Central Jersey market. We're going to just touch on that, then we're going to go to break. But with the rates being what they are, you read the national articles, and they seem to indicate that the real estate market, both for commercial and residential, is slowing down as expected because the rates go up. However, in Central Jersey, we're not experiencing that. We're experiencing a very competitive, robust, vibrant market, and that's a lot of it's due to the low inventory. You're probably experiencing the loan applications and people. So in other words, the people in that are still going out there, they're acclimated to the interest rates what they are, and they're still going ahead with the process and willing to accept borrowing in the 5 to 6% interest rates.
Yeah, sure. I mean, what everyone needs to really understand is the supply and demand of it, right? And no matter what kind of news article comes out or market prediction is on TV, there's a lot more buyers out there than there are sellers. And so the interest rates are impacting sellers more so than buyers because buyers have a need. Sellers already live there, right? So they have less of a need in a lot of cases and an overall. So buyers need to get out of their parents' home. They need to get out of rentals that they're wasting money on. Their families are growing. So the buyer demand is there and it's not going away. So I don't see a market slow down in any foreseeable future, at least year, 2 years, it's not going to swing.
All right. That's good news for the Jersey market, at least, right? All right.
Good
All right. All right. We're going to take a short break. We'll be right back after these messages. Okay. Welcome back to our show. We're joined today with our guest, Michael Vrlaku, who is a senior VP with Guaranteed Rate Affinity. So, Michael, let's shift a little bit now and talk about whether or not it's a good time to buy. We spoke about the interest rates being what they are. The market seems to be acclimated to that. From an affordability standpoint, what can the buyers do to help them? What products are out there to help buyers that are applying for loans?
Sure. So, first, when I look at affordability, because they say in the news affordability is at an all-time low, and they're looking at one calculation, but the real life scenario is, what are you comparing that to? Right? The affordability of buying a home is usually going to be compared to the affordability of renting, which rents are sky high. Right? So if you're looking at buying a home today, and it's a right decision from like your just personal life standpoint, then the numbers are very likely to work out in your favor, because we talked about the supply and demand of it. And what I think buyers should understand is that the interest rates that they get today is not going to be something that they're going to have for very long, right? Because at some point the rates are going to reverse, they're going to go lower, and they're probably going to go much lower very quickly as well. So we're going to project that you're going to take out a mortgage today and refinance in only maybe 1 or 2 years. So you could do a calculation on what that extra expense is today. So if you see a home that's, let's just say $500,000, and you're going to pay an extra 2% a year, that's an extra $10,000 in interest. So if you look at that $500,000 home and you said today, Jane, hey, how about in 2 years we buy this for $520,000? I bet you they would like that, right? Lock that in for me right now at a good interest rate, because they're thinking, hey, going up $20,000 in price is probably nothing. That can go up next week $20,000. So if you're thinking, hey, my extra expense is that $20,000, which is a tax deduction as well, right? Let's not forget that.
We forgot that, right? The mortgage interest is fully tax deductible. There's no cap, and the real estate taxes are tax deductible up to, I think, $10,000 now.
Right,
so
right. Yeah, so I mean, under that, I think it's $750 that tax deduction. But you talk about such a large tax deduction with a high interest rate, right? That mortgage payment, you're right, it's really going towards interest in a lot of ways. But you could do the calculation. So if you look at that $500,000 mortgage and you say, okay, it's going to cost me $20,000, but I'm going to refinance now. Will I pay that? Yes, because if you buy today in this competitive market, and you look forward 2 years, you might have had $40,000-$50,000 in equity, and you might be well ahead, and then you refinance at a much lower rate.
Yeah.
Right. So there's
you touch on the rental part. The reason I bought my first house when I was really young was I was renting a property, 2-bedroom property with my girlfriend. She's got engaged, so she's got to move. So I have to find a new place, either get a new roommate, or I had to either by myself. I was pounding which way is better. But in the meantime, the rent we had was really locked in for a certain rent, right? But the new one is much higher, like today's market, right?
Sure.
At the end of the day, I went to a real estate company looking for rental. And the guy said to me, why you want to rent if you're buying is cheaper? I said, how can it be? How can I buy a house paying the same or slightly lower than my rent? It's impossible. He said it is, but he showed me the first property. I didn't know anything. I bought it, and I didn't trust him, obviously. And he said, which bank do you bank? I told him my bank, a big bank. He said, okay, you go there, talk to the bank manager. So I went there. I made sure, went a different bank. I went a different bank because I thought he may know the manager, right? I was young. I was scared. So I went a different bank. I asked for a manager, and they made an appointment. They said, yeah, you qualified, no problem. And I asked the manager, why can I get it lower than my rent? He tried to explain to me, but that time, I guess my knowledge wasn't there. I just took his word. But I bought my first house based on what you just said. I figured my monthly
And your cash flow was actually cheaper in that scenario.
Plus, the market went up.
Plus, you're building appreciation, which is another key thing that we forget. In 2 years from now, the house will appreciate. You can deduct the mortgage interest, and then you have the opportunity to refinance. So you did all three things.
I did without knowing it.
And you end up selling that home, I think, for much more. So that's the American dream in essence, right? The home ownership and the borrowing and building up the equity by paying off the mortgage, writing off the taxes, and then you get so many deductions like with real estate.
Those are the the factors that I don't think home buyers, especially first-time home buyers, but even people who've owned homes a lot, they might not really understand the math of it. When you're comparing your current mortgage versus a new mortgage, right? You might have a mortgage at a 2% interest rate, but you're not having that much interest, so you're not writing off that much. So are you really calculating what that new home would be at a higher interest rate? Because you're writing off a third of that as taking away from it. So that math has to be on your mind as you contemplate this. And in your example, right, of course, if your monthly is lower, you're like, okay,
that's why I like
sign me up. But in reality, right, we have a lot of people making a lot of money, paying a lot of taxes, right, are in high tax brackets who are still renting, and they're paying a lot in rent, and so the mortgage is more. However, when you break out the principal and you focus on the interest, now you're taking your interest, cut it in a third, or take 2/3 of that. Now 2/3 compared to your rent. Now what is those numbers? Now all of a sudden now you're positive, and then you have the the price values going up, and that part of the calculation as well. So all of those things have to be factored in if you're a home buyer, if you're really trying to understand both affordability and really, is this a good time to buy? Because it's funny when you have so many home buyers, and I deal with this every day, who I really want to buy, but I know it's not a good time. And it's like, well, why do you really want to buy? Oh, the bad situation, kids don't have their own room. And it's like, listen, if you think that it's a bad time to buy from a numbers perspective, let me explain it.
Right.
And then when the numbers are laid out and they say, oh, wow, that makes sense. Now I really want to buy because my life need is to buy and move up or move somewhere else. So, those things have to be understood, and that's where I come in. So I can really, that's a big part of my job today, is just the education of what those numbers actually mean, how they compare. And look, they don't always work. Sometimes I'm like, maybe this isn't the right time. You need some time to save or something along those lines.
Everything you do, right, there's a number, like you said, it makes sense or not. At the same time, this emotional. We always say real estate, home, like a backdrop of your life. And what do you gain, what do you give up for, right? For example, like you mentioned, right, if you have a kid and if you move to a certain township like East Brunswick, there's a full-time kindergarten. So if you don't move, that could cost you $10,000-15,000. So, that could, I just have one family I represented. They had 3 children, all in private school. And in the religious school, I said, "Oh, you're Catholic." She said, "No." I said, "Why are your kids in the school?" And they said, "Oh, because the school is not the preferred. We want to have a better education." I said, "Have you ever think if you move across Old Bridge Turnpike, the place called East Brunswick, you have all of them. So now we put their house for sale. They moved to East Brunswick at the beginning. Obviously they need the money to buy, so they can't just one step, like you said, buy one. They want to buy one, but they're just not going to make sense. They just couldn't make that happen. So we're going to rent and sell the house, rent, and then buy. Because they need to sell and buy. In today's market, if you have to sell and buy, very hard to get accepted.
Sure, that contingency is tough, right?
But tough, yeah.
But to that same point, right? As a homeowner who needs to sell and buy, you got to strengthen your position, right? You got to go all the way through with your approvals, right? So I do a power bid. It's an extra step of pre-approvals where we totally underwrite everything, right? All financials underwritten. And you should probably line up the buyer and be ready to sell. So when you're presenting that offer, right, I have a buyer, they're ready to go, I'm ready to go, and it's as strong as you can be as a contingent offer.
It's as strong as you can be, but with a contingent offer, sometimes the issues are you almost have to check that purchaser's the buyer of the buyer's property. So they happen, but you could have a little bit of a domino effect, but it can be successful regardless. So you have to do
the first stop is call Michael.
Yes, absolutely, and you'll just get this.
If both buyers, I can finance your buyer, I can finance you, and now we're all on the same page.
Yeah,
dominoes fall together.
They fall together, absolutely. So we're running out of time. Let's just talk about some good housekeeping practices that you can give some advice in the next minute or so about the do's and don'ts with loans once you have the pre-approval, what not to do in terms of taking out additional loans.
Sure. Yeah. So opening up new credit affects your credit. Extending your credit. So let's say this is a credit card that you never use. All of a sudden you are using it, right? What people don't understand about credit and credit cards, the main thing I would probably get right that's really important is that it's not what your end of the month is. So if you have $1,000 limit and you spend $1,000, but you pay it off at the end of the month, well, they might report it on the 20th and it shows $1,000. So you got to think, when are they reporting it? Am I paid off by then? So try not to spend more than 33% or 50%, and at any point. And
don't take out any car loans. We've had that disaster happen where somebody doesn't even realize, and they think, oh, they took out a loan. We figure we're pre-approved. Let's go out and let's spend another $10,000
just before closing.
And it's been a deal breaker.
Your debt-to-income ratio is based on your current liabilities from that initial credit report. So if you take on new monthly liabilities, that can change everything.
Yes.
Great. Thank you so much, Michael, for being our guest. Once again, please give your contact info because we're out of time.
All right. Well, thank you both. Again, Michael Vrlaku, guaranteed rate, 732-977-9970.
Thanks again. We'll see everyone next week. Have a good one.